Hello there. Welcome to BNN Bloomberg. Happy Monday. I hope you're having a wonderful holiday season. Let's get to the big stories we're bringing you from the BNN Bloomberg newsroom. Canada will weigh opening its housing market to more foreign home buyers. In an interview with Bloomberg News, the Housing Minister, Gregor Robertson, said Ottawa will maintain its current ban on foreign buyers through 2026, but will consider changes starting in 2027. Robertson says the country needs to ensure housing is built and owned for Canadians first. And Ottawa will review what has worked in other countries, especially Australia. Canadian-based explorer and developer Altius Minerals is acquiring lithium royalty. The deal is valued at $520 million and will give Altius ownership of 37 new royalties, with the vast majority located in Canada, Australia, and South America. Altius says the acquisition will also create a significant pipeline to the battery metals component of its business. Shares in NVIDIA edging higher in the pre-market. According to Reuters, the chip giant plans to ship its H200 device to China by mid-February. The report says NVIDIA expects to ship up to 80,000 chips and also plans to add new production capacity, with orders for that capacity opening in the second quarter of next year. Beijing has yet to approve any purchases, and the timeline could shift. And there is a look at U.S. futures. The S&P 500 poised to open in a record territory. And you can see tech stocks rallying as well from the move up in the NASDAQ 100 there. Let's check out the composite, the TSX composite. It closed at a record high on Friday. It looks like we have a decent shot at achieving that again with higher oil and gold prices this morning. Let's check out oil lifted by geopolitical worries, and you can see topping that $58 after a miserable year, however. And let's have a look at gold. We've seen gold hitting new record highs this morning. There's the February future, and the spot price also hitting a new high. And the Canadian dollar, we have seen a marginally weaker US dollar against world currencies this morning. And you can see the Canadian dollar is up about 1/3%. And finally, let's have a look at Bitcoin. It has struggled over the past few weeks, but holding its own today, up about 2%. Okay, let's get the latest in the markets this morning. Gold hitting a record high. We're joined by Andrew Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Andrew, great to see you, and thanks very much indeed for joining us. What a move. The gold bugs have had a great year.
Great to be here, Andy. This has been an amazing year, to put it bluntly, Andy. I mean, cast your mind back to year-end last year, and predictions for where gold could go. We were trading south of $3,000.
Wow.
You know, even if you had said $4,000, you would have been at the far end of the curve. And here we are this morning breaking another record high. And this is holiday trading, Andy. We typically wouldn't expect this at this time of year. In fact, a lot of analysts last week thought that gold could fade in the last 2 weeks or partial weeks of the year. And yet again, we're breaking these new record highs.
It seems to be, though, for worrying reasons, in part concerns about U.S. political unpredictability and the soaring U.S. deficit.
Both of those are going to drive this market into next year as well, Andy, because we do not see any relief on the deficit front. In fact, we think the risks are that the U.S. deficit could be higher than what economists believe today. That's going to put upward pressure on gold. And to your point, Andy, geopolitical risks right now, I don't think have been any higher than they are right now when we've got turbulence now in Latin America, which again, 12 months ago, if you looked at analyst reports, that's an area that we did not think we would see this type of instability, yet here we are. So, analysts coming into the weekend now are suggesting gold could move up to $4,900 an ounce. We've heard calls for 5,000 plus. And after a year like this, it's really hard to kind of put those forecasts out to pasture, because this market looks like it wants to go higher.
Yeah, I mean, the U.S. stepping up pressure on the Venezuelan regime, and then Bloomberg reporting that Ukraine attacked an oil tanker from this famous shadow fleet, a Russia's method for getting oil out. And it did that in the Mediterranean Sea for the first time. I mean, talk about geographical spread of that war.
Exactly. And this is why we think you're going to see this pressure. Going into the next year, it depends on what the emerging markets look like. China and India, obviously, as you know, Andy, are key factors in demand for gold. If we see stability in that region or growth in that region, that's going to add to the demand pressure for gold. But we think this flight to safety is going to continue. And let's face it, 12 months ago, we were looking at Bitcoin and gold as, really jockeying for position on a preserve of wealth. Well, take a look at Bitcoin now. Bitcoin is not a preserve of wealth. Gold has really retained that title for investors around the globe.
What about these that we're just looking at Bitcoin way down from its highs, holding its own? It's been sort of in a range lately, a little bit up today, but way down from its highs, all right, of a few weeks ago. How about the U.S. tech stocks, Andrew? Are you overweight or underweight the Mag 7, or can you generalize?
Well, we're basically underweight, Andy, at this point. In terms of the AI story, it's not that the AI story is going to go away. We firmly believe that this is going to be a prevalent technology going forward. But we do think we're at the end of probably the first phase of this story. And that is the phase where now that we've built it, can we sell it and can we make money from it? And I think we're at that stage now where upcoming earnings reports could be on the disappointing side. And one of the reasons for that, Andy, is really at the end of the day, we've got to sell this stuff to a consumer, or a business has to make something for a consumer. If we are indeed going into a slowdown in the economy or recession in the economy led by consumption, that is going to put significant pressure, we think, on the ability to monetize AI in the near term. So I think we will see some near-term instability. That's not to say the story goes away, but I do think valuations right now are perhaps a little rich based on the fact we need to see results.
Let's maybe put up a one-year chart for NASDAQ 100 as a proxy for tech stocks. It was an amazing piece in The Spectator in London last week. A senior barrister acknowledging that AI was able to prepare a brief that looked pretty well as good as a professional lawyer would.
Yeah, so I guess we should be worried if we're lawyers this morning, Andy. You're going to see more and more of these stories in terms of the capability of AI. But again, back to my earlier point, we have to sell it. We have to make money off it. I spoke to an analyst weeks ago that said, in order for the investments that we've made right now in AI over the last couple of years, trillions, we would have to be charging everybody on the planet $500 per month to use ChatGPT in order to break even. So, that kind of puts it in context in terms of what do we have to make to return, to give a return on equity based on the investment we've made. Again, it's not to say the story's going away. It's not. But near term, I think there's going to be some pressure with respect to making a profit on the investments that we've made in AI so far.
Yeah. And I suppose you might say, well, if workers are going to be fired en masse, who's going to be buying the products and feeding those extra profits?
I think that's the gap, Andy, at the end of the day, when we look at the modeling of what can we expect AI stocks to do over the near term, it really is that. Because if we're talking about efficiency gains, which obviously means employment losses, that's going to put a dent in consumption. Again, if we do not have a consumer, at least in terms of the US and Canada, you typically don't have an economy. And I think that's where we have a gap right now in that analysis.
Leave us with a final thought, Andrew. For Canada, what will you be looking out for? The federal government has these massive spending plans. Politicians love to talk about removing red tape. Often easier said than done. What do you predict for Canada's economy next year, Andrew? Do you have any thoughts?
Yeah, we're pretty constructive on the economy. And obviously, we've been through a pretty traumatic year for this country, both politically, economically, and globally. We think we're entering a period now where a lot of the policies that have been put in place will hopefully start to pay off. We do like the cross-provincial trade story. We think transports in this country will do well off of that. So I think 2026, again, I hate saying this is going to be a stable year because every time I say that, the year tends to not be stable. But I think 2026 is going to be a year where we look at policies starting to kind of stabilize. We're out of that erratic territory, and I think a lot of the policies in place now will hopefully start to pay dividends. From an economy point of view, we do not see a recession for Canada this year. We think employment will stabilize, again, depending on what happens with trade. So I think this year actually could be a fairly constructive year for Canada.
Andrew, thank you very much. Have a wonderful holiday and a great 2026.
You too, Andy. Merry Christmas. Andrew
Pyle, Senior Investment Advisor and Portfolio Manager at CIBC Wood Gundy. Coming up, the U.S. pursuit of a third oil tanker off Venezuela has intensified the blockade. We'll take a look at the possible impact on oil markets after this. The Americans are apparently pursuing a third oil tanker off the coast of Venezuela, and this intensifies the blockade launched by U.S. President Donald Trump's administration. The plan here is to cut off a vital economic lifeline for Venezuela and isolate the government of President Nicolas Maduro. Bloomberg breaks down the situation and the possible impact on oil markets in this report.
For those just catching up, the Trump administration had basically taken a sanctioned oil tanker a bit back earlier this month, and that was seen as their operation. The blockade would be for sanctioned oil tankers. Not all of Venezuela's oil is sent on sanctioned tankers. There are a number of dark fleet vessels that have not been sanctioned by the U.S. Now, over the weekend, this has changed. The Trump administration boarded a vessel that was not sanctioned, and now they're pursuing another one that hasn't even loaded any crude yet. So this is certainly them trying to put a maximum pressure on companies to not be able to at least export or take any of Venezuela's crude that is sanctioned by the United States. Now, the small caveat, of course, is that Chevron has a waiver to allow them to export some of it. So it doesn't affect everything, but it is going to affect essentially most of it.
OK, so where does it leave oil prices in the context of oversupply pressures as the bigger picture?
Venezuela, it's not an enormous producer in the grand scheme of things. They have very large reserves, but they're only producing less than 1% of global demand. So if the Trump administration were to bring all of their exports down to zero, yes, you would probably see a knee-jerk reaction where you would see an increase in prices. People are trading on sentiment. Maybe there will be a mixed match between what China has to buy and they have to find other supplies elsewhere. But in the grand scheme of things, it doesn't really affect the global supply balance because the market is facing quite a large oversupply going into 2026. Demand hasn't really increased more than that supply is being added to the market. OPEC Plus is adding barrels. U.S. supply is very strong. There are other countries as well adding more. And so when you look at the larger supply-demand balance, even if you remove these barrels, you might see an increase in prices for a few days, but we are going to be trending likely downward, according to banks and analysts, just because there's so much more supply than there is demand, especially going into next year.
Coming up after the break, we'll look at what you should track in the airline sector as we near the new year. That's ahead. It has been a choppy year for North America's airline this year, but they've had help from that lower oil price. Meanwhile, though, consumers are still worried about the effect tariffs could have on the economy. Let's zero in particular on the U.S. aviation sector. Here we're joined by Stephen Trent, independent aviation specialist. Stephen, thanks very much indeed for joining us.
Thank you for having me, and happy holidays.
Happy holidays. Looking at the big U.S. carriers, I see they've had mixed fortunes. American Airlines is down this year. United Airlines stock is up. But can you generalize about the industry? Is it doing okay right now, the U.S. aviation companies?
Yeah, absolutely. And I would say when you look at the big three, Delta, United, American Airlines, we're actually bullish on the 2026 outlook. I would say of that trio, American Airlines potentially has the most exciting story. But I think a lot of this begins with the consumer. So I think you have to bifurcate the U.S. consumer between wealthier folks that are invested in the stock market and everybody else. So that former category, you still see very good demand, and you still see people that want good experiences on board. They don't want to be stuck in a cattle car. They want one of the big three, and that's why you see, basically the discount airlines all want to push premium, which I think is an uphill climb.
That's right. People, their whole model is not providing fancy added services. Yeah. The could just talk a bit about American, though, if you would. I know its stock has rallied lately, but it is still down this year, AAL shares. Why is that?
Yeah, great question. So you've actually seen a lot of broad chop in the space. So the year started really bumpy, a great deal of uncertainty and concern on tariffs. You actually, unfortunately, had a couple of very high-profile aviation accidents. None of this helped in terms of higher-end consumers and companies planning business travel for the year or even planning leisure travel. Mm-hmm. So we have seen some recovery in the stock, but when one looks at the equity market value, American looks mispriced versus Delta and United. It's still hovering around its pandemic-era equity market cap. That's in spite of the fact that we've seen a significant improvement in free cash flow. We've seen a significant deleveraging. And 2026, when we think about the potential for them to catch up from a unit revenue perspective, that, in my view, looks like a pretty exciting opportunity. So we think even today, American Airlines shares are oversold.
What about Delta? Anything in particular going for them? Any particular tailwinds for that company in 2026?
Yeah, look, so for all three of them, you have the consumer, oil prices down. And I think it's fascinating. You see a little bit of an uptick in oil on, the Venezuela stuff going on at the moment. But if one looks at oil over the last 2 decades, in real terms, oil's down substantially in real terms. If we take that oil curve and adjust it to 2025 inflation. So if you're at Delta, you've got really fantastic hub at Hartsfield. You have a robust co-branded card program with American Express. And then you have very good premium, very good lounges. I think in Delta's case, however, they're a fantastic airline, but it's probably unlikely that good to very good results from them are going to surprise anybody. I think you're going to see kind of the opposite. In American's case, they have good to very good results come through, and I think there's a good chance that surprises the street.
What about Southwest? Of course, they were the original discounter, with their model of a very simple fleet of 737 aircraft. Stock has done okay this year, up about 23%.
Yeah, absolutely. So Southwest is an interesting case. So on a fundamental level, its forward PE is trading far above where it traded pre-pandemic. If we look at the stock from a pre-pandemic basis, it had very good EBIT to free cash flow conversion, basically doing about $3 billion in each bucket. Today, if one looks at Southwest EBIT to free cash flow conversion, it's actually a much poorer scenario in both cases. So if you look at Southwest latest 12-month cash flow from ops versus American Airlines has done more than double cash flow from ops that Southwest has. What investors are focused on Southwest case, they certainly have a really good balance sheet. They have a formidable activist shareholder behind them, which I think seems to be doing some things that are potentially beneficial. But I would argue a lot of that's priced in. I'm not so sure I'd be making a bullish call on Southwest for 2026 at these valuation levels, especially given the poor EBIT to free cash flow conversion they have today. They've actually been burning cash.
One thing I have only really learned about lately is the vital importance of these co-branded credit cards to airlines, not just for building loyalty among passengers, but they're a crucial source of revenue as well.
100%. And when one looks at these co-branded card programs, I think you said it very well. Not only do you have remuneration on the income statement with the card program paying a royalty, for example, but much more importantly, from a free cash flow perspective, when one thinks about the working capital impact of that, the liability growth, because in most consumers' cases, people are generating miles in their credit cards. You know, not everybody today is spending all of their miles, for Christmas shopping. Mm-hmm. And the rate at which you can generate points and the rate at which you can redeem points are absolutely not the same. So what we've actually seen from the big three that, quite frankly, have by far the best co-branded card programs, we've actually seen this growth, this remuneration growth, actually go a long way in terms of de-risking the earnings streams. So American, for example, has its new program starting next month. We're kind of excited to see where they go with that one.
I can't remember where I read this, but the commentator was even claiming the airlines have now turned into credit card companies that fly on the side. I think that's probably going a bit far, but it is interesting how vital they've become. Stephen, just leave us with a final thought. Oh, we have to go. Listen, Stephen, I'm sorry. Thank you very much. I really appreciate it. Stephen Trent,
no worries.
Independent aviation specialist. We got the opening bells next. Right, there's the opening bell action on Wall Street and Bay Street. At the NASDAQ, Berna Technologies is ringing the bell. At the NYSE, we're getting yet more of these high-powered ETFs. Direction is celebrating the launch of the Titans leveraged and inverse ETFs. It's time for the first 50. And let's start off with the big North American benchmarks. And there you have it. Ring the bell. The TSX trading at a new record high. And our market pulling up, as you might expect, as I mentioned earlier, with both gold and oil strong today. The TSX poised at this rate for its first close above 31,800. There's the S&P 500. It was trading in record territory in the pre-market. Not quite there right now, 6,865. The record was Thursday of last week at just over 6,900, the record high close. And let me just check the NASDAQ, if you'll bear with me for a sec. The NASDAQ up about 0.6%. Still not back at its record high, which was October 29th at just under 24,000. Couple of stocks of interest here. Let's have a look at our friends at Agnico Eagle, AEM. Excuse me, that stock not back at a record high yet. We have seen at least one downgrade of Agnico over the past couple of weeks because of the run in the stock. It's become the go-to for quite a few investors because of its safe jurisdictions. But there you have it. The stock did get in mid-October just north of 263, and so it's not quite back there. Maybe you'll have a look at Barrick. It has been setting record after record. Let me just see if it's at a new high right now. It certainly is moving up under new management. And yep, sure enough, my screen is indicating that's a new record high for Barrick Mining. Royal Bank of Canada has been setting record after record, and it's slightly down, but maybe money moving over into those resource stocks. And sure enough, it hit a record high Friday. It's only slightly down from that. And maybe we could pop up a 5-year chart for Magna International, the MG in Toronto. That stock trading today, it did, Friday it hit its highest in at least a year. It has been rallying lately, but slightly down in early trading. Let's check out some movers south of the border. We're joined by Jeff Morgan, Deputy Team Leader at the Bloomberg News Equities team. Great to have you, Jeff. Thanks very much for joining us. What's the latest on Warner Brothers?
Yeah, good morning. Thank you for having me. Warner Brothers is definitely a stock to watch today. It's one of the top performers in the S&P 500, at least so far. Currently, it's up about 3.7%. It's been around 4%. What's happening here is billionaire Larry Ellison, who is partially behind that Paramount Skydance bid, has agreed to personally guarantee up to $40.4 billion in equity financing for Paramount Skydance's bid for Warner Bros. Discovery. Of course, Warner Bros. Is kind of a target and being fought over by both Paramount Skydance and Netflix. So I guess a popular place to be. You've got two other companies that are kind of vying to buy your stock, to buy your company outright. And today got a great big boost from a pretty big backer in Larry Ellison. Also worth noting that Netflix this morning announced that they were going to refinance part of their $59 billion bridge loan, also trying to move ahead with closing this acquisition. So I guess the fight for control of this company, the fight to win the acquisition continues. That makes this stock, as well as I mentioned Paramount Skydance, that is also one of the top performing stocks in the S&P 500 so far this morning, and worth watching as well.
You're also watching Marvell, the electronic device maker, the chip specialist. What's happening there?
That's right. This is worth watching as well so far this morning. What's happening so far is that Citi has opened a positive catalyst watch on this stock. And so it got a little bit of a lift in the pre-market session. It's rising once again in the regular trading session. The positive catalyst, Citi sees two things happening. First of all, there is a major electronics showcase next month. And the positive catalyst is in place between now and then. It expects Marvell Technology to announce a handful of wins over the next bit until that show, including accelerating year-over-year sales growth for 2026 and 2027, driven by data centers. It also expects to highlight a kind of a growing adoption and scale up of its networking capabilities, which is going to help it win additional new business. That's at least Citi's view. Looks like the market is agreeing with that view, at least so far. The stock is up, and it's definitely worth watching over the course of the trading session this morning.
Jeff, thank you very much indeed. Jeff Morgan
My pleasure.
Of Bloomberg. Coming up, a look back at the Canadian economy in 2025 and a preview of what to expect in 2026. Carl Shimada is up after the break. Looking back on 2025, Canadian exports and employment in trade-sensitive sectors fared better than you might have expected. But our guest says we're not out of the woods yet. He says negative effects of these tariffs imposed by U.S. President Donald Trump probably haven't arrived yet fully. And the collapse, or a possible collapse, of investment in AI is a key risk heading into the new year. Let's get more from Carl Shimada, Chief Market Strategist at Corpay. Carl, always great to see you. Happy Monday. Thanks for joining us.
And you as well, Andy. Great to see you.
So looking back on 2025, it feels like we dodged a bullet to some extent on these tariffs. I know steel, lumber, aluminum were hit, but in general, the rest of the economy wasn't that badly damaged, it seems.
Yeah, that's right. You definitely did see a bit of a hit to exports, a little bit of employment shock in sort of your trade sensitive sectors. But when you look at the overall load on the economy, we did come through with, sort of minor scrapes and bruises. And it is sort of interesting to kind of note when you take gold exports and energy exports out of the equation, Canadian overall exports are down only 0.3%, or we're only down 0.3% for the first 9 months of the year compared with the same period in the prior year. And so, that sort of gives rise to the idea that, we did have this big sort of inventory stockpiling effort in the U.S. and across the global economy that may have boosted our exports a bit. We might have sort of seen a front loading of the amount of goods leaving Canada. And we might still be, waiting to see a bit of a give back in that as conditions normalize, as, sort of we get to that new status quo for the global economy.
But, of course, we've got to get through this trade agreement next year, and there'll be lots of heat and noise and rhetoric from President Trump. I think we can confidently predict.
Yes, that's the thing. And that's sort of where things get really challenging, especially from a foreign exchange standpoint, because when we think about where the Canadian dollar might go over the next year, if the Canadian economy is, somewhat recovering, sort of muddling through, and we see a convergence in rate policy between the Bank of Canada and the Federal Reserve, then in theory, that should give the Canadian dollar a boost. But as you mentioned there, the one thing that we definitely know here is that we are going to see some overheated rhetoric at some point. We very likely will see sell-offs in the Canadian dollar related to, whatever Mr. Trump is tweeting out next. And so, it's very much a situation where we can't really rely on any forecasts or expectations for where the currency might go.
The AI boom, do you think, Carl, some of that at least could come to a screeching halt with companies slowing down their spending plans?
Yeah, I think it's definitely a risk. Clearly investors are nervous right now. I wouldn't call this sort of a huge, high probability event, but I definitely do think that there is the possibility that investors decide that this is, vulnerability in financial markets, that they reallocate to other areas of the economy, into, the more, bricks and mortar types of businesses that generally underpin growth. And if they do that, then you could see, a compression in wealth effects. In other words, investors who and households who have, seen big gains in their balance sheets over the last couple of years related to AI, that could come down a bit, and that could that could generate a bit of a consumption crunch, right? We've had a lot of talk about K-shaped economies recently. The idea that very wealthy consumers are driving a big share of spending. If they don't feel as wealthy, then we could see a bit of a pullback there. And so, I think it's definitely something that investors should worry about over the year ahead, even if it's not, a certainty, and it's not something that they should, bet on actually occurring.
I know that spreadsheet enthusiasts are loving what AI can do for them. Carl, have you found your analysis helped by AI at all in the sense of giving you ideas or doing broad-based searches?
Absolutely. I don't think so. The challenge with what I do is that it very much does depend on the numbers being exactly correct.
Right. Yes.
I cannot, I cannot work with anything that contains anything like a hallucination or anything like that. Right.
Yes.
And so far, I'm not finding that it's useful for that. However, where I do find it useful is, there was this economist, Tyler Cowen, who did a podcast a while back, and he was mentioning that, he's always been a classical music, enthusiast. And he was looking for, insight. And he said, I'm going to ask the AI how to think about, various compositions, right? And the AI came back with some guidance as to how to think about the problem and where to go for more depth. And so what I've been using AI for so far is really, how do you think about something? What's an intellectual framework to put around, a decision or a thought process that I want to go through? So it's helping me in that sense, but it isn't helping me in the sense of actually processing data just yet.
No, that's right. I find the limited use I've made, it can sort of call your attention to something and then you drill into it, but needs to be checked. Like any information, needs to be double checked and go to the original source. Carl, give us a thought about next year economically or currency wise. Is there anything that investors are underestimating right now that could hit us between the eyes next year?
Yeah, I mean, I think the big thing to really, really put out there is that right now we're in this period of low volatility, right? We're in a period in which those tariff front-running effects are sort of obscuring any fundamental view of the economy. Financial conditions are incredibly loose, liquidity's high, credit spreads are low, and this is an environment in which, investors start seeking risk, right? They go out across the risk curve and they take on more leverage and bet on things that are more volatile, right? And so the issue that I see is that, there are a number of surprises that could come out. I mean, we could see a reacceleration in the U.S. economy, right? If you look at a lot of the tailwinds that are behind the U.S. economy right now, they're quite powerful. We could actually see a re-rating in U.S. growth in the first quarter. We could see Fed expectations being pulled back, and that could lead to, a reappraisal of where interest rates are going globally. Of course, that would spill over across virtually every asset market that you can think of. We could, of course, get into a situation now where you have so many governments borrowing at very high levels, at essentially wartime levels, at the same time that the big sort of hyperscalers are intensifying their borrowing activities. And so we might have a point at which, investors get a little leery of all of this and they start, heading for the exits. And if that happens, then, we have more turbulence. And then all of that, is folding into that global economy in which, we're in a much more difficult geopolitical environment where, we're seeing more fragmentation even within domestic economies and within domestic politics around the world, at the same time that we're having a wave of technological innovation spreading across the economy. And so all that I would say here is that, it's not about making linear forecasts as to what might happen in 2026. It's that right now we're in this sort of sense of calm and complacency. And that, I think, is underappreciating the risks that are bubbling under the surface.
Carl, thank you very much indeed. And have a wonderful 2026.
And you as well. Thank you very much.
Carl Shimada, Chief Market Strategist at Corpay. This trade war with the U.S. has changed inter-provincial relations in Canada. We're going to check back on that topic after this. There's been a lot of talk this year in Canada of coming together, standing up for the country in the face of Trump's tariffs. And of course, there's been rhetoric from the premiers of each province and territory. Team Canada, that came into focus on the front line of the trade fight. But as CTV's Andrew Johnson reports, old inter-provincial rivalries were also renewed.
In a year that started out looking like this.
I think Canada is going to be a very serious contender to be our 51st state. We're going to put very serious tariffs on Mexico and Canada.
Canada's premiers, the faces of each province, became a focal point of resistance against Donald Trump's trade threats.
As Canadians, we need to realize that he is not joking.
Each standing up to defend their provincial and territorial economic engines on behalf of Team Canada. An early move, all but two, opting to remove U.S. liquor from store shelves. Manitoba's Wab Kinew took a page right out of the American president's playbook.
It's a wonderful order. It's a beautiful order. This order is pulling American booze off the liquor mart shelves.
At the White House in February, the premiers met with members of the Trump administration, presenting a united front.
The worst thing we could do as a country is not show up.
For Ontario's Doug Ford, showing up meant going on the offensive, threatening to punish America by any means possible, including restricting power sales.
If the United States escalates, I will not hesitate to shut the electricity off completely.
Ford even urged Alberta to put an export tax on oil.
Their gas prices go up $90 to $1 a gallon. They will lose their minds.
That did not sit well with Premier Danielle Smith, who called the idea absurd and self-destructive.
You can ask me as much as you like. The answer is no.
Smith, who'd been criticized for visiting Trump at his Mar-a-Lago home in January, said diplomacy, not retaliation, was the best way to deal with the president. The Team Canada narrative was also interrupted in May when supporters of Alberta separation celebrated a Smith government bill that would make it easier for voters to force a referendum. Smith said she didn't support separation, but also wouldn't stand in the way.
I will respect the outcome of citizen-initiated referenda, and that's why it's my job to make sure it doesn't get to that point.
I want to welcome everyone.
By summer, 6 months into the trade war, premiers and territorial leaders were in Ontario cottage country, talking trade, tariffs, and teamwork.
Right now, our economy in all Canada suffers because of the uncertainty.
Another goal of the three-day summit was to make it easier to move goods between provinces at a time when many discovered buying Canadian could be difficult.
I can't say how many times I've heard it's easier for me to access Alabama than Alberta.
In late September, Trump again turned up the heat, announcing new tariffs. Ontario's response got under the president's skin.
When someone says, let's impose tariffs on foreign...
A $75 million ad campaign airing on major American networks starring former President Ronald Reagan.
Over the long run, such trade barriers hurt every American worker and consumer.
Trump called the ad fake and promptly ended Canadian trade talks.
They did a crooked ad. They knew it was Ronald Reagan loved tariffs.
Ontario ended up pulling the campaign early, but the man who authorized it was downright Trump-like in declaring its success.
It was the most successful ad in the history of North America.
It was around this time cracks in the Premier's Team Canada collective widened out west over Alberta's pitch for a new pipeline to send bitumen to BC's northwest coast. Despite a hard no from BC's David Eby, Danielle Smith pushed to have the proposal added to Mark Carney's major projects list.
Premier Eby's comments are un-Canadian and they're unconstitutional. All it takes is the Prime Minister to say yes.
It's not the Danielle Smith show, it's the Canadian team. And we all deserve the same opportunity for the same federal funding for our projects as she does for hers. That's not un-Canadian, that is fair.
Smith got what she wanted, a memorandum of understanding signed by the PM.
I think it's going to unleash an incredible amount of investment.
As 2025 comes to a close, with Canada and the U.S. still deadlocked on a trade deal, we can expect a continued focus going forward on the premiers, advocating for their provinces and territories and trying to get along. Andrew Johnson, CTV News, Vancouver.
Silver and gold, not just a Burl Ives song. The markets are focused on precious metals. John Ehrlichman will have more after the break. Gold has been one of the big investing stories of the year, and this morning it's hitting new highs, along with silver. BNN Bloomberg contributor John Ehrlichman joins us with more now on that record run. John, what are the latest drivers?
Andy, good morning. It's some of the same stuff we've heard all year. Geopolitical jitters back in focus, this time just U.S. and Venezuela tensions and lingering uncertainty with Russia and Ukraine. We've heard about the geopolitical factors that have been fueling gold throughout the year. More talk about lower interest rates in the United States, which tends to make metals more attractive. And, you know, it's interesting. The stock market story for Canada this year has been helped so significantly by gold and silver reaching these record levels. Without that material strength, we'd be talking about a different TSX story. And looking ahead to the new year, Andy, I mean, the same themes that the bulls have been talking about this year seem to be on the table, at least for gold in the year ahead, whether it's central bank buying or weaker currencies because of big government spending, or maybe retail investors in Western nations following Asian investors and gobbling up gold. Some of the themes to watch in the year ahead.
And of course, some people like to talk about a commodity super cycle. I'm always a bit skeptical because commodities move in different ways at different times. Yeah. But this gold run has sparked that kind of commentary.
Well, just because, you know, if you look at other areas like the shortages in, you know, well, silver's a great example of that, but in copper or uranium, you've got all these catalysts. Everybody wonders if this is a super cycle. I think what's interesting is, in this case, if you do buy into that, you don't necessarily have to see a wholesale exit from another investing area to make room for commodities, because the AI technology story is actually linked to this. Like if we continue to see those power needs connected to AI infrastructure infrastructure, which you and I have talked a lot about, that actually builds a case for some of the commodities continuing to run in 2026. I get your point. All commodities should be treated differently, but there's been a lot of talk about that in the market.
It's been an amazing year. I mean, isn't it strange, John? Tech hitting record highs, tech stocks, and also gold, which has been around for thousands of years.
There you go. Yeah, the macro stories aligning, even though they have different flavors for sure, Andy.
John, thank you very much indeed. That's BNN Bloomberg contributor John Ehrlichman. John hosts the Ticker Take investing channel on YouTube. Coming back, we're going to look back on the U.S. markets in 2025 and explore what's next for 2026. Welcome to the second hour of The Open. Let's check out the big stories we're bringing you from the BNN Bloomberg newsroom. Canada will weigh opening its housing market to more foreign home buyers. In an interview with Bloomberg News, the housing minister, Gregor Robertson, says Ottawa will maintain its current ban on foreign buyers through 2026, but will consider changes starting in 2027. Robertson says this country needs to ensure housing is built and owned for Canadians first. And Ottawa will review what has worked in other countries, especially Australia. And we're watching shares in Altius Minerals and Lithium Royalty today. The Canadian-based explorer and developer is acquiring lithium for $520 million. Under the terms, Altius gains ownership of 37 new royalties, most of them located in Canada, Australia, and South America. And this acquisition apparently creates a significant pipeline to the battery metals component of its business. Shares in Baytex Energy moving higher after the company unveiled its targets for 2026. Baytex plans to spend as much as $625 million in exploration and development, and that is expected to generate production growth of 3 to 5%. The company says first quarter output is also expected to average up to 69,000 barrels of oil a day and ramp up to 70,000 by the end of next year. The TSX hitting a new record high, poised to break through 32,000 for the first time, and it's getting a boost this morning, among other things, from higher gold stocks. Let's have a look at the U.S. markets. They are near record highs, but not quite there. You can see the S&P 500 up about 0.5%. And let's have a quick look at oil, because oil has been moving higher this morning, in part because the U.S. is stepping up its pressure on Venezuela, apparently pursuing or seeking to seize a third oil tanker. And let's have a look at gold. It too has been hitting record highs again. You can see there's the gold futures for February, blasting north of 4,400. And spot gold also hitting a record, as is spot silver. And let's have a look at the Canadian dollar. And you can see it has moved up about 0.5%. Generally, let me just check on the US dollar. We have seen some selling this morning for the US dollar. Thanks, control room. Yep, it is slipping against world currencies. Let's focus on the U.S. stock market. Our guest says living affordability for consumers is continuing to get worse. There's lots of uncertainty among American families as subsidies under the Affordable Care Act are just 10 days away from expiring. We're joined by Michael Green, Chief Strategist and Portfolio Manager at Simplify Asset Management. Michael, great to see you, and thanks very much indeed for joining us.
Oh, it's absolutely a pleasure. I was first on the affordability crisis. I enjoyed listening to your program a few seconds before, in which Canada is going to seek out solutions for housing from Australia. That would be news to Australians that there are success stories in housing in Australia. So this affordability crisis, unfortunately, has become a global phenomenon that we are seeing rise in importance from a political framework. In the United States, it's absolutely become the critical issue, and this question of ACA subsidy expiries and the potential implications that has on cash flow, particularly to the working families in the United States, is really something that we're looking to politicians to take more seriously. If we don't, this is going to be an interesting 2026 with competing factors from the ACA subsidies and the potential for tariff stimulus. Certainly, my bias would be that the ACA subsidies end up being much more important.
That's interesting because, of course, health bills are a major source of bankruptcy in the United States. What will that mean for investors, though, if this pressure on consumers is not relieved?
Well, ultimately, it means that areas like consumer discretionary, which have received a rebound associated with things like the tariff stimulus discussions, the idea being that $2,000 checks are going to be going to low-income Americans who have an exceptionally high propensity to spend, that has been powering a bit of a rebound in the retail sector that had been heavily shorted and ignored up until very recently. Unfortunately, that suggests that if the ACA subsidies expire, that there's going to be a competing need for cash that's coming into those households. It would be a very narrow stimulus. Unfortunately, it would look an awful lot like what happened in early 2008 when the Bush administration sent out stimulus, only to find that it was largely used for debt repayment, which doesn't really stimulate the economy, or saved by higher income households.
Like all politicians, the current president, Donald Trump, tries to blame inflation and affordability on the previous administration. Do you think he'll have, what kind of president though, to reduce the cost of living or to slow the increase in the cost of living, Michael?
Unfortunately, this is one of the real challenges. The only way you address these problems that have emerged over decades, the concentration of American industry in terms of fewer and fewer providers who have gained pricing power relative to their customers, the gain in power from increasing monopolization and concentration is not something we're going to unwind, nor is the reindustrialization and the onshoring of supply. This is just not going to happen in a very short time period. Unfortunately, that doesn't lend itself well to short political time cycles. If I were advising President Trump, it would be to have an honest discussion with the American people about the steps that are being taken to mitigate this problem over time. And a disciplined application of that is really the only path to restoring his favorability ratings. That seems to be a real challenge, in particular that discipline component for this administration.
And one measure, and it could be politically tough, would seem to be just boost the incomes of lower paid workers.
Yeah, unfortunately, that would be great if the government had the ability to actually do that, other than mandating an increase in minimum wage, which would create tremendous frictional loss by largely driving people into unemployment. Or by somehow or another trying to mandate that companies needed to distribute more of their profits to workers. It's just further intrusion into a system that should be largely functional. The real problem in the United States has been the decline in progressivity of the tax code. We talk about income taxes. We ignore all the other forms of taxes that used to be paid primarily by wealthier individuals. I fully understand that I would be among the worst hit by discussions of increasing income taxes in the United States, and more importantly, lifting things like the FICA tax cap. We've heard this from Mitt Romney. You're hearing it from me. The unfortunate solution is to solve a problem is going to require a touch of sacrifice from all members of our society.
And to generalize over the decades, has the U.S. tax system become less progressive?
The overall progressivity of the U.S. tax code has become dramatically less progressive. Roughly 87% of corporate equities are owned by the top 1% of the U.S. population. That puts us into a situation in which the corporate tax rate becomes the mechanism for collecting taxes on those individuals. Because we removed barriers to true free trade, which there were benefits from, that meant the capital became increasingly mobile relative to labor. We've seen that arbitrage through a move offshore to regions like China. That now has to be unwound. Tariffs, for all their inelegance, are a mechanism for trapping capital inside a country and making it taxable. This is one of the positive benefits that the Trump administration has introduced, is one of the first reintroductions of the idea of, if you are going to sell products to the American public, or for that matter, the Canadian public, which is obviously much smaller and a much less attractive market, you're going to have to pay taxes on those products.
Michael, always great talking to you. If we're not joined by you again in 2025, have a wonderful holiday and really look forward to hearing from you in 2026.
Same. The best to all your listeners. Happy holidays, and thank you for having me on. I look forward to talking with you in 2026.
Thanks a million. Michael Green, Chief Strategist and Portfolio Manager at Simplify Asset Management. Coming up, AI and automation are part of the American manufacturing landscape. We'll bring you a Bloomberg doc on one research facility which is journeying to understand how AI might reshape factories. AI and automation are part of the U.S. manufacturing landscape. Bloomberg met with a predictive maintenance company and visited a research facility to understand how AI will reshape factories.
At the Interactive Robotics Group Lab, deep inside a research facility at MIT, engineers are training these robot arms to do something that might seem a little basic.
The robot is trying to pick up this ball, and then it will try to put it in the sink.
But these simple tasks are not really simple at all. The robots in this lab are being trained to use artificial intelligence to intuitively and safely recognize instructions from humans, even predicting what steps they should follow next.
Now, I want to nudge it to pick up a different ball. Okay, so I can just push it in that general direction, and then that robot auto-completes the detailed motions. As if you're teaching this robot a sport, right? If it's not doing the sport perfectly, you can just give it a nudge. What you are seeing here is a human-robot collaboration experience where user only gives super high-level guidance, and then the robot auto-completes the low-level granular motions.
It's all part of an exploration into what the factory of the future might look like. A place some think won't be totally taken over by robots, but where humans and robots work side by side. Ben Armstrong has spent the last several years studying how AI and automation are becoming part of the American manufacturing landscape.
The Work of the Future task force at MIT got started in 2018. One of the big questions, which is a question on many people's minds, is are there still going to be jobs once these technologies really take off? Is this going to displace all sorts of different workers? And what they found was that these technologies actually move slower than we think. And when they diffuse through the economy, they affect workers more incrementally than severely.
This isn't quite how big businesses once imagined the automation revolution would go. In the 1980s, General Motors built what it hoped would be a car plant so automated, it was said the lights could be turned out.
And it backfired dramatically. It became the laughing stock of the manufacturing community. You know, the stories were of robots painting each other versus painting cars, of not really knowing which bumper to affix with which body of the vehicle. So it was really a comedy of errors that resulted with this factory of the future.
In terms of AI as the secret sauce, I think we're still real early. Automation is all over the place. I spend a lot of my time writing about Amazon, which has been at the forefront of robotics robotics and logistics for more than a decade. Even there, they've backed off the dream they had at one point of a dark warehouse, saying, no, listen, we think humans are going to be in the loop for the foreseeable future. We're a long way away from the dream of, a robot being able to go from station to station, switching between tasks and kind of monitoring things on its own.
In fact, as of 2021, just about 12% of American factories used even a single robot. Asia is way ahead. China alone operates more than 40% of all robots currently in use in factories, according to an industry analysis. Automation and robotics is just one piece of the advanced computing landscape making its way into the manufacturing process. And where AI is showing up, it's often a lot more subtle.
So we're here at our line 21 extrusion line, and we've integrated our augury AI solution. This is our augury endpoint.
At this Fiberon composite decking plant in North Carolina, an AI-enabled device made by a company called Augury helps predict when the machines might break down. Fiberon says the device has repeatedly protected them from costly surprise maintenance.
Without the sensors, we can have an unexpected failure in the process. They can occur on the weekend. They can cause unplanned downtime.
Sar Yoskovitz is Augury's co-founder and CEO.
We have our own sensors that we physically install on the machines, which measure the vibration of the machine, the temperature, the magnetic emissions of a motor, and then we apply very sophisticated algorithms in order to tell you exactly what's wrong and also what you need to do in order to fix it. The best example I can give is when you drive your car, sometimes you can hear the fan belt is squeaking, and you know that you need to replace it or tighten it. So different malfunctions have very unique patterns that we learn how to recognize. Today we use very sophisticated algorithms all the way from deep neural networks through reinforcement learning, all the way now to transformers and the more modern generative AI solutions in order to not just tell you something is wrong, but also help guide the technician in exactly what they need to do in order to fix the issues.
Augury isn't the only company doing predictive maintenance. It's one of the fastest growing fields in manufacturing AI. Like a lot of AI entrepreneurs, Yoskovitz prefers to see these tools as not a job eliminator, but a job creator, and maybe even as a way to solve a worker shortage problem.
One of the questions we always get from people on the production lines is the computer coming in to replace me. And in fact, the goal is not to replace people, it's to arm them with new tools, more modern tools. Instead of looking at all of their thousands of machines every day, now they can focus on the 5 or 10 machines that actually need their attention. It's hard to overstate the challenges that manufacturing executives and manufacturing companies are facing today. On one hand, they're trying to meet the ever-shifting consumer demands. On the other, they're facing increased tension and pressure over geopolitical issues, growing supply chain resiliency problems, and an aging workforce. So the talent shortage is actually the biggest challenge that we're hearing from our partners and customers.
Of course, AI is not a panacea. Earlier this year, a survey by the World Economic Forum found that 41% of businesses across all sectors expect to reduce their workforce by 2030 thanks to AI.
AI is a tool that companies think might enable it to do a better job, right? Like if say a computer vision algorithm can more precisely identify defects in something, that's probably going to make their product better as it rolls off the line. But kind of by definition, a lot of these applications for AI today would make some of the humans who do those jobs redundant. That doesn't mean that the companies won't come up with other things for folks to do, or that companies don't have unmet needs they might be able to retrain people for. But if AI isn't job replacement, it's definitely job disruption.
Over the last 45 years in American manufacturing, there's been extraordinary job loss. The question is, how much of this job loss was due to automation versus offshoring and the general decline of American industrial competitiveness? I think that's a big question. At those factories that adopt robotic automation, do you see, for example, fewer machinist jobs? Actually, you see the opposite.
How should the robot move to ensure that, 1, it gets to where it needs to go, and 2, it doesn't crash into the human? If the human ever gets too close, the robot should stop.
The other side is, well, what do we really want from the manufacturing industry in general? Do we want a growing manufacturing industry that is a bulk of American employment like it was in the post-Second World War era? I don't think that's practical, and I don't think that's necessarily what we want either. What I think the goal should be for manufacturing jobs, but also jobs elsewhere in the economy, is that we want higher quality jobs that people find more satisfying.
People are always holding up that straw man of, are we going to recreate the world where you can roll out of high school and roll into a well-paying job with, a retirement attached? And that just seems so done in vast swaths of industry in the United States.
Companies definitely try to introduce automation to reduce jobs. So I'm not saying that companies buying automation solutions are benevolent. The biggest enthusiasts of automation favor machines over humans because they say humans just introduce error, they take bathroom breaks, et cetera, et cetera. But what they don't realize is that humans in a lot of senses can see what machines can't. So yes, there are predictions that there will be algorithms that can improve themselves, but right now, a human in the loop is going to be far superior to a machine on its own.
Up next, gold and silver hitting all-time highs today. Lindsay Biscaya has more after the break. Gold and silver hitting all-time highs today amid escalating geopolitical tensions. We've got more now from BNN Bloomberg's Lindsay Biscaya. Lindsay.
And this is pretty interesting to see, Andy. Gold, silver, and copper all up today. So gold has reached above $4,400 an ounce, so a new record for gold. Silver spot reached a record high of $69.04 an ounce. That's up almost 5% from where it closed out at Monday. And then if we look at copper, also heading toward $12,000 a ton on the London Metal Exchange. So this, for copper, would be the biggest annual gain since 2009. The reason for this, some economists pointing toward those geopolitical tensions that you mentioned, obviously what's happening in Venezuela, also Ukraine hitting a Russian tanker ship in the Mediterranean Sea. So that could be part of the reason, but more economists actually looking at the possibility of rate cuts by the Fed next year in the U.S. There's a lot of expectation at this point, I should say, that there will be at least 2 rate cuts near the beginning of 2026. And that is obviously pushing the price of gold and silver higher today, just with people betting on what they might see next year.
And silver has just been spectacular. Spot silver is up almost 140% this year.
It's crazy to see the run of silver. And silver obviously gets underlooked sometimes, or not the same appreciation that gold gets. But we were seeing Peter Hodson with I2I Capital Management. He joined us on the street this morning, and he was talking about silver outperforming gold due to a physical shortage. Like, there's literally not enough of it. There's not as much production of silver as there is when you compare it with gold. So that's part of the reason. Silver also starting to be used more in AI data centers. So there's more uses for it, more demand for it. It's used for semiconductors, switches, controllers, a whole bunch of different aspects when it comes to AI data centers. That's also been driving the price up quite a bit. And here's more from Hodson in terms of what to expect with silver.
But it also is an industrial use. It's a great connector. It's a great conductivity metal. And it's now getting lots of usage in AI data centers with cooling applications, connectivity applications. And this has kind of come out of nowhere. Silver is kind of, over the past 18 months or so, it's like, you know what? It's now an AI stock, or it's an AI metal. And of course, everything AI has gone a little crazy. And so you get that kind of extra boost in addition to all the other things that are helping out gold. So I think silver probably outperforms in the short term. The big question, of course, will be what happens when there's a crisis in the market, or there's a crisis in the economy, because that industrial usage for silver will hurt it when people get scared of the economy or they get into worries about a recession.
So interesting to hear that. Hodson says he doesn't expect to see the same returns for gold and silver in 2026 that we saw in 2025. But he says there's enough momentum right now to keep that run going for a little bit, at least for a couple more days. As you mentioned, silver up 140% year to date. Gold is up more than 70%. Copper up almost 40% year to date. So it's been not a bad year for metals.
Lindsay, thank you very much indeed. Lindsay Biscaya. On Friday on Market Call, we were joined by David Burrows, President and Chief Investment Strategist at Barometer Capital Management, and he was covering North American large caps. His top picks were Rio Tinto, Eli Lilly, and Tesla. And today on the show, it is Lyle Stein, President of Forvest Global Wealth Management. He's taking your questions on North American and global stocks. Up next, a Toronto-based tech startup has secured a $20 million seed round to develop its data securities network. We're going to hear from the CEO after this. We are watching shares in Altius Minerals and Lithium Royalty today. Altius, a Canadian-based explorer and developer, is acquiring lithium for $520 million. Altius gains ownership of 37 new royalties, with most of them, the vast majority, in Canada, Australia, and South America. It says the acquisition creates a significant pipeline for the battery metals component of its business. Shares in NVIDIA higher after a report from Reuters that it plans to ship its H200 chip to China by mid-February. The report says the chip giant expects to ship up to 80,000 devices and also plans to add new production capacity, with orders for that capacity opening in the second quarter of next year. But Beijing has yet to approve any purchases, and the timeline could shift. Shares in Honeywell International edging lower after the aerospace and industrial conglomerate cut its full year and fourth quarter forecast. The move comes after reclassifying its advanced materials business as discontinued operations following a spin-off. Honeywell also expects to pay a one-time cash settlement of $470 million US related to the FlexJet lawsuit. FlexJet is a private jet services company that sued Honeywell for breach of a service agreement. And there is a look at the North American markets. The TSX now trading in a record territory, boosted, of course, today by gold stocks. And you can see the U.S. stocks are also up as we head into the week of trading. Of course, things are going to be getting quieter over the next few days as people get ready and people take off for the holidays. One stock on our radar this morning is a company with a very boring name, Information Services Corporation. Thanks, Control Room. That one is moving higher. It has received non-binding takeover offers, according to the Globe and Mail, from bidders including Investment Management of Ontario, OMERS, the giant Ontario Municipal Pension Fund, and these bids adding or valuing the TSX listed company apparently at up to $58 a share. Now, we did know that back in September, ISC confirmed that it was engaging in a strategic review. This is a database firm, and just a reminder, it has said it's open to a sale. Transcripts just secured a $20 million seed round backed by leading venture funds. The company specializes in data encryption and can rank work done with the governments of Turkey and Ukraine as clients. The effort here, of course, is to get key information to citizens securely. We were joined earlier by the Transcript CEO, Zain Zaidi, who was recently named to Forbes 30 Under 30.
While we've been doing great on the enterprise side of things, what we did about 2.5 years ago, 3.5 years ago, time flies, is at the start of the Ukraine war, we enabled Ukrainian refugees to get access to their verified medical records. So traditionally, medical records are stored at hospitals. It's very hard to access hospitals in an active war zone. So we enabled on-chain, self-sovereign medical records that we gave access to these refugees so that when they received treatment in Europe or wherever country that they were going to, they had access to these credentials. So to date, we've serviced over 100,000 such refugees in Ukraine, as well as in Turkey and a handful of other countries.
And that's incredible to hear. And how important is that, then, social enterprise to your company?
Extremely important. We've built Transcripts with kind of the goal, and it's our ethos, actually, that we want to build a company that does good, obviously, we are a for-profit business, so for our shareholders, but also have used some of our technology, give it on a pro bono basis to nonprofits and other institutions that could use it for good.
And what's the benefit for you with that?
Yeah, well, the first major benefit is kind of on the personal side, right? Both my parents are immigrants, so it kind of touches us personally. Same with my co-founder. We view the world not necessarily just as Canada only, but as a global society, and we want to help out people globally. But second of all, I think technology as a whole has kind of developed a bad reputation for itself. I've spent a good amount of time of my life in the Silicon Valley. Things like AI, crypto, all these buzzwords. If you ask the average person of them, they don't necessarily have the best opinion of these words. And that's because there's fear. And quite frankly, some of these technologies have been used to disadvantage a good chunk of the population. So we hope we can change the narrative and show that technology can actually be used for good.
And let's talk a little bit about the company itself. What's the focus for you?
Yeah, in the Canadian market, we're primarily enabling Canadians to own their verified employment and income credentials. We want you to be able to own where you work, how much money you make, and ultimately disrupt the model that the credit bureaus have. To date, we've scaled that business quite rapidly, 30x in the last 2.5 years. Now with that seed round funding, we're going to continue that growth here in Canada, as well as the United States. Actually, I was just recently informed that we are the fourth or fifth largest provider of employment and income data, right behind the 3 large credit bureaus. So we're pretty excited to be continuing to double down on that mission and enable people to own their own verified employment history.
And what are you doing different from them that you think you can move past them?
Yeah, so the credit bureaus they serve as middle parties. Banks, landlords, employers rely on these credit bureaus to verify and validate our own information, whether that be your credit score, where you've worked, your income history, et cetera. What we're doing is we're giving consumers the ability to actually own their verified record. So we integrate with truth oracles, like we like to call them, that can be like HRS databases, so the human resource information systems at large enterprises, and they can then, using that information, they can prove that they've worked at these enterprises. They can then take that verified record and share that directly with a third party, like a lender, a landlord, a future employer, directly, not having to rely on the credit bureaus. Doing it this way is a lot more compliant with both Canadian and U.S. law, but also, quite frankly, a lot more efficient because you don't have to have a middle party going and fishing these records. And also, from a data privacy and data security perspective, the only person who has access to your credentials is you and the person that you decide to share it with. So we think it's just, all in all, a much more efficient system.
And what are you doing to guarantee? How are you guaranteeing that security and that safety?
All our credentials are end-to-end encrypted. That's something that, quite frankly, the large 3 credit bureaus don't even pretend to offer. In 2017, Equifax was responsible for the largest hack in North America. 180 million odd records were exposed in that hack. So only person who can access your credentials is you and any person you share it with. We use encryption keys. The private keys only held by the user itself.
And can you access it at all? Can your company access it at all or no?
No.
Once it's locked away, it's locked away. What's it like, just quickly, what's it like being in Toronto, being in Canada as a tech firm and trying to grow this and trying to develop it at your age as well?
Yeah, well, interesting fact, we were originally based in the Silicon Valley. We had our primary headquarters there, but we've begun the process of opening up a second headquarters and, quite frankly, moving our primary headquarters from the Silicon Valley over to Toronto. And we think Toronto has all the right recipes for a growing tech firm like ourselves. It has great universities like the University of Waterloo, University of Toronto, that have produced amazing engineering talent. It has a growing domestic market and growing domestic demand for new technologies, as well as favorable business laws. The Canadian government's done a good job, at least not heavily regulating spaces like ours. So that builds innovation and for us to actually build. So we're pretty bullish actually in the Canadian market, but specifically the Torontonian market.
Coming up, hot picks in consumer staples, including one company that our guest says is making significant improvements and focusing on innovation. That's after the break. Time for Hot Picks. Today we're checking out consumer staples. Our guest has Colgate-Palmolive as his top pick. He says the company is making significant strategic improvements under the current leadership, and he expects improvements going into 2026. We are joined by Filippo Falorni, Director in U.S. Beverages, Household Products and Personal Care, lead analyst at Citi. Thank you very much, Filippo. Always great to see you. Colgate-Palmolive, remind us, what do they sell? I know it's toothpaste. Do they sell other stuff as well? And why do you like the stock, Filippo?
Hi, Andy. Thanks for having me on. Yes, definitely. Look, Colgate is mainly a toothpaste manufacturer. Oral care are 50% of their business. So that's mainly toothpaste and toothbrushes. Those are the two big categories. But they also have a different portfolio. So 20% of their business is the pet food business, which is sold under the Hill's brand. And then 30% of their portfolio is under the Palmolive side of the equation. So that's mainly hand soap, dish soap, and other house cleaning products, as well as some other personal care products. So it's a pretty diversified household product and personal care business.
And what are the big changes they're making?
Yeah, absolutely. Look, I think one thing that they are really pushing towards is innovation into next year, especially on the toothpaste side. They've really focused on trying to improve their market share trajectory in the US, where they've been losing share to some other players like Sensodyne. And look, across the world, they're really pushing bigger innovation across different categories. The other thing I would say, look, it's been a period where there's been the pullback at the consumer level generally. You've seen a deceleration, both on the pricing front, because remember, these companies took significant pricing in 2021 to 2024, and then volumes are now a little bit more stagnant. So companies have to find ways to grow and increase their market share. And Colgate has definitely made a lot of progress. They increased their advertising spending, they're increasing the R&D budget. And I do think in 2026, you should start to see some of the benefits from these strategic initiatives, in addition to easier comparisons as you look ahead what they're comping in terms of growth in 2025.
We're tight for time. I'm sorry about that. Procter & Gamble, a classic consumer staples name. What draws you to this stock right now, Filippo?
Yeah, absolutely. Similar to Colgate, right? You've seen a pretty big deceleration in trends in 2025. The stock has also underperformed. P&G remains one of the most defensive names in the group. So it's a very stable company with a lot of growth in their core businesses and stability on cash flow and dividends. Also, similarly to Colgate, they had some idiosyncratic impacts in 2025 that they will cycle in 2026, including inventory destocking in the US in the first half of the year. And so we think 2026 is going to be a better outlook for the company. They also have a new CEO and strategic changes as well that could improve the top line trajectory.
And finally, Celsius. Remind us what their main products are, Filippo, if you would, and tell us what has drawn your attention to the stock.
Yes, Celsius is an energy drink company, so shifting gears to the beverage space. They have three major brands: the Celsius brand, which is the namesake of the company, Alani Nu, which they acquired in February of this year, which is a more female-friendly energy drink, and then Rockstar, which was recently acquired from PepsiCo as part of their distribution deal. So energy drinks in our space is one of the fastest-growing categories. They're attracting new, younger consumers and increasingly female consumers. And the other thing that we like about the stock into 2026 is that they signed a distribution deal with Pepsi. And so in 26, you're going to see Alani Nu transition to the distribution of Pepsi from Anheuser-Busch. And you should get incremental shelf space opportunities for Alani Nu, which could drive at least 40-50% growth for the brand. And the stock has pulled back recently after last quarter, which was below expectations. But we actually think the pathway into 26 is very attractive here.
Logically, could we well see an acquisition of Celsius by a bigger beverage maker?
That's a good question. It's been rumored in the past, potentially, that Pepsi would be interested in acquiring the whole company. This could happen. Recently they assigned a distribution deal, which is still a very important step. And Pepsi increased their ownership stake to 11% of Celsius. So there's still definitely some potential of them potentially being acquired by Pepsi. It's just probably the most likely buyer in these circumstances.
And I guess distribution is central, isn't it, in the beverage business?
Absolutely. Distribution is what gets the product in front of the consumers. And as you think about it, like the Celsius brand, which is the brand that they own that has been around for longer, now it reached pretty good distribution in the US, pretty comparable to their main competitors, which are Monster and Red Bull. But if you look at Alani Nu, which is the brand that they acquired in February of 2025, that's only about half of the distribution point of Celsius. So our point is that with the Pepsi distribution, you should be able to significantly close that gap in 2026, and that should give incremental sales, incremental touch point with consumers, and that could drive an acceleration in the sales growth for the Alani Nu brand.
Filippo, thank you very much indeed. Really appreciate it.
Thanks for having me.
Filippo Falorni is Director, U.S. Beverages, Household and Products and Personal Care, Lead Analyst at Citi. Coming up, we're going to break down why Generation Z feel poorer than their parents, even as they work harder than ever. That's ahead. Gen Z, or let's call them Gen Z, we are in Canada. They've been called the rejected generation in economic terms. Let's get more from Hanif Bayat, founder and CEO of WOA Leads. Thank you very much indeed for joining us.
Thank you for having me.
Just remind us, what is WOA all about? What do you
We are
do?
a personal finance platform with
Yeah.
more than 1,000 guides, calculator, and content that more than 500,000 Canadians come every month to learn about mortgage rates, GIC rates, or like incentives, tax, and everything about personal finance.
And Generation Z are people who are typically between 28 and 16.
Yes, these are the people who typically looking for entry-level jobs.
Okay, so they're pretty young.
Yes.
You say there is evidence that CPI inflation numbers indicate that sure, incomes have kept up with inflation over the years, but you say that hides an important component when it comes to accommodation, housing. Tell us about that.
Exactly. So when they try to evaluate the present value of the income, they use CPI inflation to see that what was the value of the income, for example, 20 years ago. But there is some problem in it because not 100% of the income goes for living a life or consuming products. Actually, a portion of that goes for building a life. Building a life is a bit different than living a life. So when we look at this, the CPI is looking at like your grocery stores, like shelter, internet, your costs that you need to survive and live a life. But in reality, you need to save for retirement. You need to, many people need to buy assets for financial stability. And when it comes to that, you see that the power of median disposable income actually decreased since 2000. So what we did in our studies, we said that, okay, make an assumption. 80% of the income goes for consuming products. So we use CPI for that 80%. But the 20% goes for saving, and saving happens...
20% should be saved.
Yes.
Yeah, okay, sorry.
Should be. So 20% should be like 15 to 25%. So we assumed like 20%. And we assumed 3 different asset classes. So first case was the average home. Second case was the S&P TSX, a net total return. And the third one was the precious metal. In our case, was gold. In all 3 scenarios, means that we assume still 80% of the income goes to consumer products. So you use CPI inflation for that one. But for the 20%, we use asset inflation. We see that actually the power of median disposable income has decreased since year 2000, slightly.
Now, just zero in on mortgages and the principal repayments of mortgages. You argue that it's not fully reflected in CPI numbers?
No, in CPI, actually, There's nothing about principal payment.
Okay.
So in shelter component of the CPI that is tracked is mostly on focus on rent and also interest payment. Interest payment, you don't pay the principal.
Okay.
So it's for living. Mm-hmm. It's not about that you're accumulating assets. So that's the problem part. So when no one should use 100% of their income to consuming product. You need to money for, for uncertainty, for retirement, for many different things. And that 20% that is assigned, you see that the poverty has decreased significantly in the last 2 decades.
So people between 16 and 28, it's not a myth that they've been falling behind economically.
Not at all, in my opinion. Because some people come and said, oh, you see the median income based on CPI actually slightly increased. Mm-hmm. But as I said, there's a bit misleading because no one should spend 100% of their income in consuming product, and they want to buy home, they want to buy asset stocks, and actually that freedom give them an ability to do more risk. So when these people are they cannot build a life by buying asset, actually they become more conservative, and that itself will add another factor to make them they feel behind because they cannot decide to do a risk like start a business or something, because for that you need at least some money, some buffer. And this is what we did we have seen it. And this generation, they're under pressure in different areas. It's not only this one, but this is one aspect that even if they find a job, the job payment is not as good as before for building a life. But this is not the only thing. When we look at AI, AI is disrupting everything eventually. But currently, as of this moment, it's disrupting entry-level jobs. And these entry-level jobs, who is looking for them? Gen Z. For example, firsthand, myself, I have seen that in our company, we had interns in programming, computer programming, that are very qualified. They have been very qualified, and previously, these people were finding jobs very easily. Mm-hmm. And I've noticed that some of them are in the market for more than 1 year. And they are good from good schools, good grades, even had internship. And this is something that I have noticed. I'm shocked at how struggle with the entry-level jobs. So it's not only even they find a job, the power of income. Besides that, even the entry-level job has impacted heavily by AI.
Hanif, we'll have to leave it there. Fascinating topic, and thanks very much.
Thank you for having me.
Hanif Bayat, founder and CEO of WOA. Okay, we're out of time on the open. Morning Markets is coming up next. Thanks very much for tuning into the show.